GameStop Redditors, hedge funds, stimulus check, billions of dollars. How did the hedge funds become worth billions of dollars when they seemingly do absolutely nothing? Is it possible that they might have been robbing money from the average person, you and me? Did they almost drive Tesla out of business? And what type of shady practices did they use? And how does that relate to GameStop today? I'm going to be taking a look at all that and try to give you a greater understanding by shining some light on this dark corner of the world. I'm going to try to keep this simple. My goal is to give you an understanding of some of the illicit activities that go on in the dark corners of Wall Street and the hedge funds that operate with basic impunity, and why you should feel zero compassion for these hedge funds like Melvin Capital that have theoretically been taken to the bank by the Game Stonkers and WallStreetBets, the subreddit that they were operating from. And I want to underline that it's only theoretical that they've cost Melvin Capital a lot of money, and I will circle back to use Jen Psaki, the new White House press secretary, her terminology, but I will do so at the end of this video, so make sure to stay tuned for that. I'm also going to be discussing how Tesla was nearly put out of business by these fiendish ghouls, and the enormous negative repercussions that this would have had on many people, not only in the United States, but throughout the world. Now, as I do, I ask you to do two things. If you gain any knowledge or enjoy this video, please share it with people so that they also can broaden their scope of wisdom and knowledge. Now, also, please, by all means, turn that like button blue. Just hit that little like button. Do it now. Get it out of the way. You get a little endorphin hit when you do. Just turn it blue, thumb up the video. And by all means, if you're new and you feel that I've given you some value here, subscribe so that you'll be notified in the future by hitting the all notifications bell, and you can stay tuned and current with what we're producing here. Many of you guys are likely familiar with the show Billions, about the hedge fund industries and the egos and imperfections that are involved that make these people rise to the top and often cause their demise. These are by no means perfect people, and they are simply not above playing dirty games to win. That is for darn sure. Now, a lot of hedge funds do what's called shorting companies. Essentially what that is, it's a bet that the price of the underlying stock that represents the company will decrease in value. When you think short, you want the price of the company to grow shorter. You don't want it to grow. You don't want it to grow taller. You short the company, you're betting that the price will grow shorter. I just give you that as something easy that I hope will help you understand as we move forward, and I use that word. Now, there isn't anything inherently wrong with shorting. Again, betting that the price is going to go down, sometimes it exposes massive frauds. We're talking about like WorldCom and Enron. And it offers people that are willing to dig through the financials and do the research, it offers them a financial incentive to uncover such frauds so that the market is somewhat protected. You know, if you continue to pump out those lies and no one checks you on them because there isn't the financial incentive to do so, then many, many more people get suckered in before that fraud gets unearthed. This helps keep them somewhat, and I underline somewhat because Wall Street is not the most honest place, honest. And also the Securities and Exchange Commission, the SEC, they simply don't have the capabilities to uncover all these frauds. So this is actually a beneficial thing for society to have people that are willing to do this. The challenge comes in when the hedge funds take their position and then they try to manipulate the price of the stock in an effort to drive it to zero, drive the company out of business. If they are successful, they achieve a 100% profit. Pretty decent for them, at least. And when you're talking about hundreds of millions or even billions of dollars, there is tremendous incentive to achieve this. Now, in the long run, the price of a company is directly corresponding to the amount of profits that it is producing and the future profits that are expected. So the near-term valuation differences matter very, very little. You can sway the price one way or another for a temporary period of time, and it's not going to make a big difference. However, if a company's stock goes to zero or starts approaching zero, there is the potential that they'll lose everything. And the hedges and the shorts that are taking such huge positions, betting on the downside, on the short side, are heavily incentivized to see this through. So, This is how they do it. So one way, you keep selling the stock. You just keep shorting it. You keep punishing the price of the stock. And what this does is eventually it triggers algorithms that cause a further reduction in the price. And then individual investors start seeing the price of their stock collapsing and say, I better get out of it while I still can. And they sell into the weakness rather than it going to zero, and the price further dematerializes. And there are very few people that are willing to stand under a falling dagger, which is what's called a stock that is decreasing very rapidly in price. If you can create enough doubt in an otherwise solvent company, you can literally collapse the share price. This actually happened in the crash of 2008 when everybody was on the sidelines and scared to make a bid. Again, they do not want to catch the falling dagger. And the ensuing panic almost took down the entire financial industry, which would have negatively affected you, your family, and every single person in the world. Not that some of these companies did not deserve to go under. They definitely did. But the shorts had the entire system circling the drain, and their intention was positively ruthless. So let's say a billionaire who has a huge ego takes a short position, a heavily short position in a company. You have the resources, the incentives, and the connections to try to actually destroy the company so that you make money. How, you might ask? It's a fair question. One way, hire, quote unquote, air quotes, journalists with some clout to write negative stories about the company. Watch here. This is Jim Cramer. He discusses this in a 2006 interview as to how you are able to manipulate information to drive the price of the stock down, which he did do, which he's admitting right here, at his own hedge fund. Note that when he mentions RIM, Research in Motion is the company that he's talking about, the creator of the BlackBerry, and Apple in 2006. This was pre-iPhone, and it wasn't the behemoth that it is today.
When your company's in a survival mode, it's really important to defeat Research in Motion and get the Pisanis of the world and the people talking about it as if there's something wrong with RIM. Then you would call the Journal and you get the bozo reporter on Research in Motion and you would feed that there's a Palm's got a killer it's going to give away. These are all the things you must do on a day like today. And if you're not doing it, maybe you shouldn't be in the game.
Okay. Another stock that a lot of people are focused on right now seems to be Apple.
Yeah, Apple's very important to spread the rumor that that both Verizon and AT&T have decided they don't like the phone.
Right.
That's a very easy one to do because it's also you want to spread the rumor that it's not going to be ready for Macworld. And this is very easy because the people who write about Apple want that story. And you can claim that it's credible because you spoke to someone at Apple, because Apple isn't and it doesn't.
Right, they're not going to comment. They're not going to say.
So it's really an ideal short. And I would, again, if I were short Apple, I would be working very hard today to get that. And the way you would do that is you pick up the phone, and you call 6 trading desk, and you say, "Listen, I just got off the phone with my contact at Verizon, and he has already said, listen, we're a Lucky G house." We're a Samsung house. We're a Motorola house. There's no room for Apple. They want too much. We're not going to let them in. We're not going to let them do what they did to music. And, I think that's a very effective way to keep a stock down.
Right.
So you can see the rampant dishonesty which exists on Wall Street. And normally this is just shark trying to eat shark and anybody who's trying to day trade, something that I would definitely dissuade you from doing because these market manipulators absolutely know what they're doing and they have a knowledge edge and a technological edge over the average investor who's trying to do this. So please, by all means, stay away. However, the big challenge that I have is over the last several years, they've tried to do this with none other than my favorite company, Tesla. It's one of the most fantastic things to have happened to America in the last several decades. And Elon Musk has created actual wealth, real wealth, by improving the automobile and bettering our civilization. We should all be huge fans of the man. And just for the record, we actually did have a Tesla for a little bit less than a year, and it is an amazing car, and I am by no means a car guy, but when you hit that accelerator and you just start flying and you don't have to fill up in gas and you just charge at home, it's absolutely amazing, and I highly recommend, if you haven't, that you go out and test drive one. Please, by all means, do. It's amazing, and you're supporting a man who's trying to better America every step of the way. So these shorts, they take their positions and then they tout to the public the reasons why they did and try to build a wave behind them. Here is one of the more famous shorts who actually lost his shirt. betting against Tesla, Mark Spiegel.
Oh, the name of this presentation is Tesla is Still a Zero. And that's a play on a presentation I gave at the Robinhood conference in November 2016, which was called Tesla is a Zero. And when I gave that presentation, the stock was in the 180s. And around 6 months later, it was in the 380s, which is my way of saying that that's a better disclaimer even than this is. So, 3 broad reasons why the equity in Tesla is worth zero. Number 1, Tesla's financials are horrible and worsening even before massive competition begins arriving later this year. Number 2, Tesla has no moat of any kind and in fact now possesses trailing technology in all facets of its business. And by the way, I can go into the weeds on all of this stuff, so grab me anytime and I'll explain these things.
So the question that, in fairness, you might be asking is, he and everybody else who shorted Tesla, he was open with his position, they were all wrong, they lost a lot of money, what's wrong with that? What I want you to understand is that these giant hedges, for their own ego and personal gain, did everything they could to destroy this now iconic American company. How? They pumped negative stories about Tesla into the press. Tons of them, actually. So let's say that you're considering purchasing a Model S or a Model 3, and you're being told by the media that the company will soon be insolvent. Do you not think that will make you think twice before buying? This in turn costs the revenue to the company, the lifeblood of the company, which would then force them to go and raise capital. And even if they're successful, they're going to be paying a much higher price for it because they don't have the same leverage that they would if things were moving in the right direction and they just want money to expand. This also might affect an employee who's reading all these negative stories in the press and says, you know what, I'm jumping ship, this company's going under, I'm going to go elsewhere and take my talents there. This makes the company unable to function and therefore more likely to go out of business when you can't fulfill an order. It also affects the suppliers of the company who are wondering whether or not the finances are going to be in line. They're going to ask Tesla for an advance, something that Tesla might have problems coming up with over and over again. Again, this hastens their demise with all this negative press that is intentionally being put out there by the big hedges. So Tesla, they go under. Employees go to the unemployment line. Investors lose all the capital that they put in. And everybody who owns a Tesla owns something that is going to rapidly decline in value because there isn't the service to take care of it. Everybody loses, save the hedge funds who shorted Tesla and did everything they could to destroy it. They are the ones who pocket the money from the investors, who live off of the misery of the workers in the unemployment line, the added government dole, the people sucking off the government teat, and the hedge funds have their additional few yachts. It's parasitic is what it is. And look, Wall Street is a dog-eat-dog world. It ain't pretty by any stretch of the imagination. But okay, Tesla, thank God, they managed to pull it out. However, had these hedge fund companies been successful, they would have prospered at the expense of everybody that I just mentioned, and America and the world as a whole. And of course, the politicians who are in their pocket would have granted them their tax breaks. And these are just some of the ways these egoic, greedy hedgies actually try to destroy good companies and the livelihoods of many, many people for their own gain. They produce zero, and they're not only living off of the labor of others, but destroying, in fact, what other people have built, like Elon. So when you see the GameStop in action and the fury that exists against the hedges and the shorts, it is completely understandable why people feel this way and the motivation that exists behind their actions. Now, to close a loop that I had mentioned previously, I'm not sure exactly whether or not Melvin Capital has, in fact, closed out of their position and that they've lost as much as they are claiming to the game stonkers. You'll see with this clip, honesty is not exactly a policy amongst the hedge funds.
But what's important when you're in that hedge fund mode is to not do anything remotely truthful. Because the truth is so against your view that it's important to create a new truth to develop a fiction.
So you're talking about the mechanics of the market.
Well, the mechanics are much more important than the fundamentals.
Oh, okay, well, but in terms of the fundamentals, you've been writing about how you think...
Who cares about the fundamentals? Research in motion just blew out the quarter.
Right.
But look what people can do. I mean, that's a fabulous thing. The great thing about the market is it has nothing to do with the actual stocks.
Right.
Now, look, over maybe 2 weeks from now, the buyers will come to their senses and realize that everything that they heard was a lie. But then again, Fannie Mae lied about their earnings for $6 billion. So,
right, and Bristol Myers lied.
It's just fiction and fiction and fiction. And I think it's important for people to recognize that the way that the market really works is to have that nexus of hit the brokerage houses with a series of orders that can push it down, then leak it to the press, and then get it on CNBC. That's also very important. And then you have a kind of a vicious cycle down.
Right.
And it's a pretty good game.
Melvin Capital said that they closed out of their position, but I have my doubts. They actually received a capital infusion from their hedge fund buddies, and there is no way that they're closing out of their position at 10 times what the stock, GameStop, is actually worth. What they're going to be doing is they're just going to be waiting it out until invariably the hold the line crowd succumbs to game theory and just starts selling at a profit, at least the first few that do. And then the price will subsequently collapse when everybody else sees the others exiting the positions. It's just game theory. Sad to say. What they're doing by making this claim that they closed out of the position is they're trying to remove the pressure from the boot on their neck by getting the game stonkers to exit their positions. This is the psychological ploy that's being used. And yes, the price of the stock will invariably, and I mean invariably, go down and in rapid succession to what it is actually worth, because this is the way that markets work. However, I want to say that this was a success because Melvin Capital, in order to get that cash infusion, had to borrow money from their hedge fund buddies. And these guys are all sharks, and they definitely took a bite out of Melvin, and this will change the way going forward that they allocate resources in terms of their shorting, and they don't want to be caught in this position again. So they did lose some money. I just don't think that they closed out of their position. In the next video that I make, I'm going to be talking about what actually happened with GameStop in a very simple manner, hopefully a way that you guys can understand. So if you're new to the channel, please subscribe and hit the notification bell, all notifications. And if I provided any type of service, please, please, please hit that like button, turn it blue. You get that little endorphin hit when you do turn that like button blue. Just thumb it up right now and feel free to share this video. Peace and blessings, everybody. I hope you have a fantastic day.